Yesterday went through equities, today fixed income and money market securities. Let's look at the latest Treasury bill auction at the primary level that took place on the 7th. Here it is. Basically, the action is really at the 364-day bill. 400 billion was offered, subscription of 956, and you can see the stop rate at 19.63, about 3 basis points up from 19.60. Let's get to the federal government retail savings bond. That window closes today. Minimum investment of 5,000, 2-year bond at 16.13 at 17.1. And, I guess you can go with a registered broker in order to invest there. You can see the coupon payments there at the bottom of your screen. Who better to discuss this with than Mr. Oladipo Ajayi, Head of Fixed Income at Chapel Hill, Denham. Good morning, sir. Good to see you again.
Good morning.
Great.
Seeing you again.
So let's start with T-bills. Why does the 364-day bill keep getting all the action from subscriptions?
Well, if you look at it from the perspective of return, and if you check the results, you will notice that the long-dated instrument actually stopped at 19.63. And but because it's a discounted instrument, so the effective return is about 24.4. And so when you see a 24.4 return in such an environment as that, it looks attractive to anyone that actually have idle funds that you can actually quickly put somewhere. And don't also forget that sometimes last year, January, this Treasury bill was trading at 8%. And now look at it, between last year and now, we've actually moved that long to around over 20%. So it gives you a sense that there's no other time for anyone to actually want to take advantage of market than now that market is actually giving this level of return. Gotcha. And I think that's one of the reasons why a lot of people actually. Another thing also is that, when you actually invest short-dated instrument and mature, by rolling, if we are rolling in again, rolling over it, there's tendency for reinvestment risk,
right?
Because the time could have changed at that particular point in time, so you may not get that attractive yield at anymore. So that's one of the reasons why people investing in the short end of the market actually want to go for a 1-year instrument.
Gotcha. Now, you were talking about idle funds. I think it's about 50 million naira to participate at the primary level. For those who don't have that kind of money, how do they get in?
Well, for people that don't have that size to actually invest, and that's one of the reasons why most asset management companies have a money market fund. Because as you speak, you see most money market funds are currently returning over 21%. And don't also forget that they are open-ended funds. So you are not tied in. You can leave anytime you want to. So it simply means that if you put your money in today and in 2 months' time, you actually need the money, you don't necessarily need to wait till maturity. You can actually call your fund. And also it's a sense that people can actually maximize their savings. Instead of you just to leave your money in the bank account, you can just put it in the money market account.
Right.
Anytime you need your fund, you can actually access the fund because it's more like open-ended fund. And I think most of the requirement is just for you to give about 24 hours notice before you can actually get credit for your withdrawal. So it makes a lot of sense. So if you can actually invest in more like Treasury bills, you can capitalize on most of these money market funds around.
Fantastic. Flexibility. People like flexibility. So what are the triggers that move T-bill rates? What are the factors there?
Well, like I said, I told you last year in January we were 8%.
Yeah.
But don't forget, in February, the central bank did 400 basis point rate hike. We came again in March. They did another 200 basis points. Another 150 basis points. And like that, we keep seeing more like rate hike. So interest rates is one of the key things that can actually continue to push return on Treasury bills higher. And aside the interest rate, another thing is inflation. And because one of the reasons why you continue to see interest rates go up is if there is inflationary pressure. And that's exactly what we saw last year. And that's one of the reasons why the Apex Bank remained very hawkish throughout the year. So that's also another thing also is the size of issuance. When you see the issuer, like federal government, if you see them come to the market with huge volume, so what it sends to the market is that, they're actually very desperate. As a result of that, you can actually capitalize on what is happening around that and I want to get a better return in that regard. Also, the posture of the monetary policy guys, if they are very hawkish, you tend to see, just like in the last 2 weeks, we've seen several more issues by the central bank. And what they're trying to do is to actually mitigate the pressure on FX and also reduce the liquidity in the system. And by so doing, when you are doing that, also, you are pushing OMO rates up, in the same concept, market want to push the rates on the Treasury bills up.
Gotcha.
And these are some of the things that's affecting markets.
This is why we have you on the show, so you can break these things down for us. Let's quickly talk about the federal government savings bond. Okay, that one, I mean, 5 million investment versus 50 at the primary market Treasury bill. You got the 2-year and the 3-year, 16-17%. What's your, is it worthwhile? Is that investment worthwhile on the savings bond?
Well, one of the reasons why the DMO actually introduced the savings bonds market is at a time, to invest in a bond market, you need about 50 million plus 1,000 naira.
Yeah.
And so it means that you have actually removed certain population to be able to actually take advantage of that or actually invest. And that's what actually brought about the savings bond. And also, it's a way to actually introduce investment culture into our system. And that's why they did it in a way that it's just 5,000 naira minimum that you can actually invest. So it's not targeted to most people like you and I.
Yeah.
So there are a lot of people out there, the market woman and some of these things. You can start, is a way to save. Because these things, the issuance comes every month. So imagine you coming in every month to actually buy a 10,000 naira.
Right.
By the end of the year, you'd have done 120,000 naira. And don't forget, that is excluding the return.
Right.
And aside that, the returns are paid quarterly, like normal bond that is semi-annual. So what they have been able to do is to introduce more like a cash flow privilege to investor. So it means that if I buy a January savings bond,
yeah,
I'll get coupon in every January. I'll get in April. I will get also in July, and I'll get also in October. So it gives you the idea that a way to actually plan your cash flow, and that's one of the reasons why it was actually introduced. So I think it's doing a very good job in the market because one way or the other, a lot of people are getting more aware about it. A lot of people are subscribing to it. Currently, you see, the rate for a 2 year is about 16.173. When you look at a 3 year, it's about 17.173. Not a bad investment. Rather than you just put your money in savings account, that you are not yielding anything. You understand? You can just put in such investment that continue to actually yield at least a reasonable return to you.
Well, almost out of time, but very quickly, what's your trajectory for rates as we roll out to the rest of this year?
Well, like I said, the first thing is about the current global issue that's currently happening. And that's one of the reasons why we'll be seeing a lot of pressure on our FX as we speak currently. And also oil price is also another factor. So one of the things is that as we continue to see clarity around this thing, and I expect things to actually settle anytime soon. And immediately that is done, I think we'll see more like a rollback from the current auction system that we're currently seeing. By the end of the year, I think I will see a less hawkish monetary policy guide, considering that we expect rates to actually drop by then.
Oladipo Ajayi, Head of Fixed Income, Chapel Hill Denham. Always a pleasure having you on the show to talk fixed income money markets. Thank you so much for your time.